Hello everyone, welcome to today's video. We will be talking about Facebook parent Meta Platforms ahead of its first quarter earnings results, which are due in a few days, with the company trying to turn things around after the 2022 hardships. I'm your host, Nikos Zabouras, Senior Market Specialist at FXCM. Just to stamp this video, it is being recorded on Friday, April the 21st, a few days ahead of the expected earnings from Meta Platforms. Before, however, we proceed, as always, please read carefully through the risk warnings and the disclaimers, and then we will get started. Once again, please read carefully through the risk warnings and the disclaimers, and bear in mind that whatever is discussed here today does not constitute investment advice and should not be taken as such. Okay, let's get the ball rolling. Again, with this video, we will talk about social media giant Meta Platforms, formerly known as Facebook. And we will start with the challenges it faced during 2022, which were quite heavy, let's say. Then we will move into this year's strong beginning as it tried to turn things around. And then we will do a recap and talk about what we expect from the upcoming earnings report, which is due on Wednesday. So first of all, starting with what was bad last year, the company had to face a negative external environment. The tech sector and growth stocks are generally more vulnerable to high interest rates. I have talked about that again, and high inflation, of course, both of which surged in 2022. More to it, big tech had come and still is under increased regulatory scrutiny. And this has also impacted Meta's operations, let's say. Advertising revenue, Meta's main source of revenue, took a hit last year due to Apple's iOS privacy changes, which wasn't exactly in Meta's control, so we still put it in the external environment. And of course, various regulatory changes, mainly due to Europe's Digital Markets Act, which aims to regulate big tech, and also because of the strong USD. These are all things that had been mentioned in last year's earnings and other communications by the company. And of course, weak advertising demand partly due to USD inflation and other factors had a negative effect, not only on Meta platforms, but also other social media apps. Of course, those challenges had an impact on the firm's top and bottom lines, and of course also increased competition from, let's say, cooler apps such as TikTok, for example, which now is facing other challenges in the United States. And as such, we had disappointing financial figures last year. Revenue, for example, stagnated in 2022. It actually was marginally lower year over year, around 1%. And net income slumped by 41% to just over 23 billion. So this is quite a clearly bad picture for the social media giant. Of course, another big part of the firm is of the metaverse. In late 2021, the firm changed its name to Meta Platforms, as it is known today, from Facebook formerly, to highlight its decisions to highlight the decision to focus its energy and resources to developing the metaverse, a digital world, let's say, and also change its reporting structure to reflect that. However, building the metaverse is a costly undertaking and also a long-term pursuit. Reality Labs, the segment responsible for delivering on this vision, lost an eye-watering nearly $14 billion last year. Again, that's massive. Now, although the firm has tried to push on the metaverse with various hardware like the virtual reality headsets, collaborations with companies such as Microsoft, some apps to help it gain traction, it is not a compelling offering yet, and there's no killer app to make it so. The whole thing seems obscure and has not really gained the appeal of user nor investor, and the technology is simply not there, I believe. It's definitely a long-term project. Of course, all of that translated into a very bad year for the stock as well. And the year, actually, 2022, started in the worst possible way. And let me bring the chart forward so we can actually see that. So you can see over here on the left that the stock wiped out more than $80 within just one day in early February of 2022. The plunge occurred right after the earnings release of that month, which was for Q4 of the prior year, sparked by poor financials and disappointing forward guidance due to Apple iOS privacy changes, which we talked about earlier, and of course other factors. You can see this steep decline right there. The stock continued to spiral forward lower after that through the course of 2022 and hit 7-year lows in November, setting around 65% overall in 2022. Again, 65%, that's massive drop. However, and let's turn back to our presentation now. Mr. Zuckerberg, the CEO of Meta Platforms, did not stay idle and looks like he listened to investors who were calling for cost cuts and less money thrown into the metaverse, which is a money pit, as we described earlier, with the massive loss that it posted last year. So in late 2022, the firm slashed 11,000 jobs and announced another round of layoffs this year, just last month, of 10,000 jobs. More to it, Mr. Zuckerberg dubbed 2023 the year of efficiency. That happened earlier in the year during the firm's earnings for the fourth quarter. And he said that he will focus on making the social media giant stronger and more nimble. And also the firm lowered the 2023 cost guidance by around 5 billion for the full year, right? Now, another thing which I believe has been helpful is that the metaverse seems to be fading. We already talked about it is obscure, it does not really seem to have gained traction, and of course it is a huge hole in money pit in terms of financials. It now appears though that Mr. Zuckerberg is shifting away from the metaverse in a subtle way, though. It's not like it has denounced it or anything dramatic like that, but it appears like he's shifting resources and attention elsewhere, which brings us to our next point, which is artificial intelligence. It's not only that the metaverse is a long way from being complete and that has not gained appeal. Something else also came along late last year that stole its thunder. And of course, we're talking about ChatGPT, OpenAI's artificial intelligence powered conversational chatbot, which has taken the world by storm. It is a ready for use product, very popular, that would reshape many aspects actually of everyday life, not only how we search the internet, right? And big tech, of course, has rushed to roll out rival services, with Microsoft, of course, being ahead, harnessing the power of its collaboration with OpenAI. Now, artificial intelligence, of course, is something I would say rather broad with many aspects, and Meta has already been working on such technologies for a long time. But it looks like Mr. Zuckerberg is now moving away from the metaverse and putting his efforts into the hot generative AI front. In late February, a couple of months ago, he announced a new product group focused on generative AI to turbocharge the firm's work on this area in order to leverage the technology for improving its existing services. And more to it, in an interview with Nikkei, CTO Andrew Bosworth said that the CEO spends most of his time on this area, although of course the generative AI technology will be used in the metaverse as well. So markets seem to have liked these cost-cutting efforts, slashing of jobs, moving with more with better pace on the AI and seemingly leaving the metaverse behind, are all things that markets liked. And now let's go back to the chart, and we can see here on the right of the screen that the highlighted area is in early February, right after the Q4 results, when the stock jumped. Why? Because the year of efficiency narrative during that earnings report was music to the ears of markets, helping the stock extend its recovery after it had bottomed out in November. Again, cost cuts, layoffs, focus on generative AI is viewed positively by markets. The stock closed the first quarter with a surge of more than 75%. Of course, there were other factors in place, such as a slowdown in the pace of monetary tightening by the Fed, and broader positive sentiment in Wall Street, which had a very good beginning to the year as well. Now that brings us to next week's earnings report. They are expected on Wednesday, April 26, after US close, while many other tech heavyweights also report within the same week. Also, members of the FANG, anchoring Amazon and Google, are due during that same period. Now, according to investing.com, Meta is projected to report revenues of $27.62 billion, earnings of $2 per share. This figure would be worse than the year-ago quarter, while revenues would also constitute a sequential decline as well. Meta's own projections call for sales to be in the range of 26 to 28.5 billion. Again, that would mark both a decline both on a yearly basis and on a quarterly comparison. And now, in order to recap what we talked about and highlight the focal points during this report, financials, as we said, will be in the spotlight. Not only revenue, but also profits and the performance of Reality Labs, which did very bad last year. Will it continue to drag Meta down? Will revenue decline further as expected, or are they going to bounce? That's one thing. The other is, of course, user metrics. Last year, we said how financials were pretty poor, but user metrics were more encouraging. Daily active users increased for Facebook and the entire family of apps, which includes other than Facebook, Instagram, Messenger, and WhatsApp, and other services. Can Meta build on this improvement, or will they be, again, face pressure, because we had seen those metrics stagnating for quite a long time? Then the other one, focal point, of course, is the metaverse. We already talked about it, how it hasn't gained traction. It is a money pit, and now Meta seems to be shifting, let's say, away from it. Is this so? Will new communication, let's say, confirm that or validate this shift? And also, how does the company progress with artificial intelligence, given this focus on this area now, as we discussed above? These are some of the things that we will be looking at. And also, let's go back to the chart to talk a little bit about the technical aspect. We said how it posted a relief rally, we could say, in the first quarter with a huge surge in the stock price. And it closed last month above the 38.2% Fibonacci of the drop from the 2021 highs to the 2022 lows, and also formed a golden cross. A golden cross is when a faster moving average moves above a slower moving average. Here we have the exponential moving average of 50 days and 200 days crossing. That is generally viewed as a potential precursor of sustained strength. However, there is a little bit of a mixed picture, and it remains to be seen if it can carry forward, because on the other hand, what we have is seeing the stock losing momentum recently, while the RSI on the bottom right, you can see that after the peak, the highlighted peak here from the results earlier in the year, you can see that the RSI has been diverging lower while the stock price has been going up, and this could and this sometimes suggests not only a fade, losing momentum, but also the beginning of a decline. So there is a bit of a mixed picture there after a very strong start to the year. So that's it from me. We'll be waiting for the results. And again, we highlighted some of the things that I will be looking for during this report, the upcoming report, but there are obviously many more things to watch out for. And just to remind, the release is expected on Wednesday, April 26th, after US markets close. That's it from me. Thank you for joining.